What's going on YouTube? In this video, we're going to talk about Under Armour, ticker symbol UA. Under Armour reported earnings last week and beat on revenue. And unfortunately, we don't know exactly if they beat on EPS since there was no expectations. But we can see down here for annual EPS estimate of 49 cents. Year to date, Under Armour is down 22% over the course of 1 year, down 8%, and they do have about a 4.2% short interest against the company. In their earnings summary, we can scroll down here, we can see company increased their gross margins by 260 basis points up to 48%, so that is very good. Under Armour also repurchased 50 million of its Class C shares for a total dollar amount of 475 million of their $500 million buyback program, so that program is almost completed and will likely be completed, in the next quarter or two. Overall guidance on the company was pretty flat. Revenue is expected to be down 2.4%. Gross margin, they're expecting to grow even a little bit more. Operating margin, flat. And we can see here their expectations on the company is between 47 and 51 cents per share. But although one thing we want to take a peek at though is capital expenditures are now expected to reach between 230 and 250 million dollars. So we're going to take a peek at that. Over here on the financial spreadsheet, we've got UA plugged in. Come over here, we got all of our charts to look at and see how Under Armour is performing. So we got a revenue, gross profit, and net income. Revenue relatively flat, gross profit slightly down. Revenue and is also relatively flat. But also, if you can see, if you can kind of connect the dots, it looks like it's back on track to where it should be. Gross margin last quarter 46%, trailing 12 months sitting at 44.7%. History is telling us that that is the lowest trailing 12 months gross margin they have had. Best they've had obviously is 50%, so they can do much better on gross margin, which they are forecasting for a little bit of an uptick in gross margin overall. One thing to note is this last quarter column is not this most recent quarter, but the quarter before this most recent reporting. So as we go through some of these numbers, they will be a little bit different than what has been reported last week on their most recent earnings report. Net margin only at 6.6%, but last quarter sitting at only 0.6%. Revenue and gross profit year-over-year change, almost no change in the trailing 12 months. Return on invested capital, 8.5%. PE ratio sitting at 7.7 today. Earnings yield, 12.5%. So earnings yield is growing, and return on invested capital, it'd be nice to see that thing tick up a little bit more yet. Cash and short-term debt. The company's got more debt than short-term cash, and we'll take a look at that and break that down a little bit more once we get over to their 10Q. Net income to free cash flow, a fair amount of net income, but negative free cash flow. We come over to here, here's our negative free cash flow, and we can see a big portion of our negative free cash flow is attributed to capital expenditures, and they are forecasting these to increase. So they're expecting, instead of 190, they're looking for 230 to 250 million in CapEx to finalize the year out. Share count dilution, it is getting bought back, but last quarter to the trailing 12 months, still 400 within the 455 million share count range. So now we're over here on the 10Q, the most recent quarter report. Company has cash and cash equivalents of $655 million, almost $656 million of cash. Down here, long-term debt coming due has just transferred from long-term to short-term debt because this debt note is coming due of $81 million. Company does have plenty of cash to cover that debt. However, throughout the rest of their short-term liabilities or current liabilities, they do have a lot more debt that adds up to $1.3 billion. And they've only got $656 million in cash. And unfortunately, within these total current liabilities, there's nothing that we can really cross out to give us a better cash to debt ratio. In total liabilities, company has $2.65 billion in total liabilities. Revenues, we can see in 3 months end, basically flat, and 6 months end, also relatively flat. Gross profit, though, we can see that their margins are increasing and went from 714 million to 752 million in gross profit with lower revenue. Pretty good. Net income, because of their gross profit, they did carry a majority of that down to their net income, so very good as well. They are buying back shares, which we know, we've gone over that. We can see the reduction in share count there. On to the cash flows. We have $118 million in net income, and this is in 6 months' time. Come down here, we got some stock-based compensation still getting paid out. That is up year over year. We've got inventories, which have been reduced. Prior year, they did grow, which is why, as you add inventories, it's a negative on cash flows, but a positive on your balance sheet. But we've reduced inventories slightly, about $33 million down. Down here, that gives us a $64 million cash from operations over the last 6 months, but we have CapEx of $84 million. That gives us a negative free cash flow of $20 million. Then we come down here into finance activities. We can see they bought back $50 million worth of shares. And then their net increase, or actually decrease in this case, was $54 million in total. So they had $727 million beginning period down to $673 million after they bought back their shares. Basically, that was the majority of the reason why they saw a reduction in their cash. Also, just a side note is in 2027, the rest of their long-term debt that they have issued of $600 million will be coming due. So they've got, 3 years left till that even comes up. So we got plenty of time to not worry about that. On to the comps for Under Armour. We have Nike, Adidas, and Puma for comparisons, and we scroll down to our comparisons charts. Market cap to revenue comparison across the board, we can see Nike is the leader. We come over here, revenue, gross profit, net income. We can kind of compare the companies and how they're doing. We can see Nike is really the only profitable company on the board. Growth rate, Nike and Under Armour have the growth rate at the moment. These two are not listed, probably because they're a little bit more of an unknown company. As we can see up here, they do not have much for financials on that. We can see gross margins is where they're at. I mean, it's about 45 to 46% roughly is their margin range. Operating margin, though, same thing. I mean, we're looking probably maybe if they can push up to 10% like Nike, Under Armour would be doing pretty good. So we'll see if they can manage to increase their operating margin. Profit margin, Nike's able to do a 10% almost profit margin as well. See if, and the profit margin on Under Armour did get significantly better there. Free cash flow, Nike, positive free cash flow. Everybody else is negative. Return on invested capital, 8%. Nike sitting at about 15%. Price to earnings, going to pay a little bit of a premium for Puma. I'd rather own Nike than Puma based on price to earnings. And obviously Under Armour here is sitting at about 8. Earnings yield, we got 12%. So pretty good earnings yield on Under Armour. Nike sitting at 3%. So based on margins here, obviously Nike definitely takes the cake on the board, but Under Armour's it's got a chance, I think, based on margins. Onto the calculator spreadsheet here, we got Peter Lynch Valuation gives them a fair value of $2.07 per share. We have multiples comparison. We're going to eliminate Puma because they're negative. That gives us, based on Nike and Adidas, for a price on this company for $77.18. Manu PE, the company does have cash from operations as negative, so this does not work out. Price to book, 5-year average 3.5. Price to book today, 1.5. Graham's valuation gives them intrinsic value of $9.25. Discounted cash flow. Analysts have a 0 expectation growth rate. Actually, I think it's negative 28%. So I just said, we're just going to do a growth rate of 0. However, they are negative free cash flow anyway. So this calculator will not be used. Rule 72, we have 3 sources of an EPS growth rate. Seeking Alpha at 0, Yahoo Finance 22, and our calculator at 2.3% growth rate. So we average out those growth rates is 8% EPS growth. That goes into 72 basically 9 times. That goes into 10 years 1.3 times. So we get to double our EPS. Basically 1.3 times, so that gives us 1.9 roughly for a future EPS for a fair value of $7.70. So the fair market that we get on Under Armour is $15.30 per share, 30% margin safety, $10.70, and analyst price target of 0. There is no analyst price target on this company. Very unpopular company to have been valued by analysts. So you might find an analyst price target on another website or somewhere, but the source that I grab my information from, there is no analyst covering this company. But that is a price target, leaving in a negative discounted cash flow price per share. Basically, that will offset our multiple, our high multiple value. So I will leave that in there. So over here on the stock chart for Under Armour, I have a few trend lines drawn in. We have a resistance point up here at $23 per share. And we have a support range down here, which is basically where the stock is at of about $5.74. We can see that is pretty close to all-time lows in the last several years, 10 years. So, we're sitting right about here and we're trading at like 2010 levels on this company right now. We've also had this pretty steep downtrend that was drawn in here, but since the company has broken out of it, but then came back and retested the lows again. But since with earnings, it did push up a little bit more last week, but did give back some of those gains. I also have a Fibonacci drawn in here. I sometimes will use these, but not very often. Gives me sometimes an idea of where things could be headed for another price target. So we have in here a fib that's drawn at these lows to these highs up here. And we can see that we could potentially see a resumption up to maybe $9.50, potentially a retest of these highs. Earnings were pretty decent. Stock reacted positively to earnings and was up a pretty good penny once earnings were released. So overall, I would have to assume company could come back up to about $9 to $10 per share, which is slightly below our valuation of $15, a fair market value of $15, which would be up in this range, up in the middle of the fib. One thing I want to add in here, we're on macro trends. We want to take a look at revenue, gross profit, and operating income. Obviously, we're trading, like I said, at about 2010-ish levels. And obviously, that should tell us that, well, maybe we're at 2010 level revenues. Well, we're doing basically $5.9 billion in revenue today. 2010, $1 billion. Okay, so we're doing a lot more revenue. We come over to gross profit. We'll see we're doing gross profit, $2.6 billion gross profit today. And 2010, $531 million gross profit. All right. Operating income. What do we have for operating income? So operating income, $284 million operating income. And in 2010, we were doing $112 million in operating income. We can take a look at net income as well. Net income, $387 million today. And in 2010, only $68 million. And another thing, let's take a look at is see what our share count was. 462 million shares. Actually, it's 455 million shares. We know that. So we do have a significant more amount of shares. So we have about 58 million more share count. So we are more diluted. 2010 EPS was 17 cents per share, but today 84 cents per share. But that is it for Under Armour. If you found value in this video, drop a like, subscribe, comment. I'm back later on our stock analysis video.